It's the end of the year, and like every end of the year in the mortgage industry and real estate, increasingly you're hearing from people saying, what are interest rates going to do? What are sales going to do? And we're going to address that today. I'm going to give you a little teaser in our conversation today, and I'm going to invite you, if you want to learn more, by all means, get a copy of my newsletter. And if you're interested to go even deeper than that, reach out and we'll have a conversation about the modeling I do. I perform 108 pages of analysis using a variety of VAR, SREMA, and neural models to be able to come up with the predictions and analysis on what's going on in their local market. Now, while the analysis is built on Southern Ohio, I think it would be equally applicative for Indiana and Kentucky. I think you can, within reason, say that those markets are going to be very similar. Might even extend to Tennessee and some other areas. So, anyway, so the first question is what do I think mortgage interest rates are going to do? And I've heard a couple of people talking about interest rates and suggesting that maybe interest rates would hover around 6%. They didn't expect a lot of change. I'm going to tell you, especially after today, I don't think that is probable. Today we got really great news that CPI was at 2.7%. They were expecting 3.1. Now, not to get too wonky on the specifics, but that is a massive shift and massive difference. And what it shows is that inflation, by most considerations, it sounds like that we're getting a grip on that. So with the advent of that coming out, previous to today, when we were talking about Fed funds rate, which is not directly impactful on mortgage interest rates, but it does have a strong correlation, meaning that usually if federal funds rates go down, that generally that it's a leading indicator and mortgage interest rates will follow. So we were already enjoying the benefit of having the lower rate that came across from the Federal Reserve on the quarter point. Now it's looking like a 75% probability that they're going to lower them again come January, probably another quarter point, particularly since unemployment is at 4.7%. And so the Fed is now going into a more bullish approach to addressing and stimulating the economy. So that addresses mortgage interest rates. It's my belief that in the first quarter of next year, we're probably looking at interest rates in the high fives. And we could potentially be looking at mid 5 range next year, depending on a variety of different impact factors. The first one is if we have overheating in the economy, then that will have an inflationary impact on mortgage interest rates. So we'll have to watch that very carefully. But there's a lot going on, namely with energy. That's something we're not even addressing here, but it has a really pervasive impact across the board. Now, we're going to talk about sales, active listings, condition of the overall market. So for some time, for the last couple of years, we've been seeing quite a bit of energy that has been going down as far as sales. We've had a pretty precipitous fall for probably the last 2 or 3 years. And I'd say even more than that, but you might not have felt it. But certainly, many realtors certainly know that the market is down now, particularly in the coastal regions. For the most part in the United States, we have a tale of two economies right now when it comes to real estate. The coastal areas, the Floridas, the Californias, the New Yorks, they're really getting hit pretty hard. They also have more volatile markets, and it goes up a lot faster than our markets here in the center part of the United States. Now, right now, our markets here in the center part of the United States have weathered it fairly well. Now, is our volume the same as it was a couple of years ago? No. But still, it's remained a little bit closer to consistent. We're not as volatile. We don't experience the highs and the lows, though it got kind of crazy. So that's we're not even close to having a bubble, as I hear some of that nonsense we simply don't have the inventory to allow such a thing to happen. So we still have a historically low level of inventory, and that's something really important to pay close attention to. And there seems to be a consistent amount of demand for the product, obviously. So, it's a mixed bag, I guess, and we kind of held our own in 2025. So looking forward into 2026, where are we and what does it look like we're going to do? Well, if I'm going purely by the models that I do, then 2026 in the beginning is going to look really fruitful, and then it's going to go down pretty heavily in the later portions of 26. However, I want to tell you that my models don't capture macroeconomic situations that are going on, policy, and things that you can't really quantify in a very statistically responsible way. We have a lot of wins, some of which I've already mentioned. One, the fact that we're looking like interest rates are going to be going down. We're looking at employment at 4.7%, so there's strong reason for the Fed to hop in. But then when you combine this with the One Big Beautiful Bill and the impact of that, and the criteria which I mentioned in my report, from the highest to lowest as far as impact, these items are very severe, and they're going to have a real material and physical contact with real estate next year and the economy as a whole. So frankly, I'm thinking in alignment with what NAR has as far as their predictions are around a 14 to 15% improvement in sales volume next year. And I might even think that might be a little light compared due to some of the stuff that I'm reviewing. So what's your take? If you have some different opinions, I mean, right now it's anyone's guess. I like to do the analysis so that I got an excuse to hide behind, I guess. But love to hear from you. And if you have questions, want to talk about this deeper, by all means, give me a call or throw me an email. My information is in the below. And thank you so much. I'll talk to you then. Bye.